Hey everyone, and welcome to This Explainer. Today, we're tackling a really massive thesis that's currently rippling through the financial world. We're going to be looking at some comprehensive data that points to one incredibly bold conclusion. The crypto and equity markets have officially bottomed out, and we're literally standing at the threshold of a major news cycle. If you've been feeling the pain of the recent market drops in your own portfolio, you're definitely going to want to pay close attention to how this data unfolds. Now, what's really interesting about this quote from Jamie Dimon is the massive shift in perspective it represents. I mean, this isn't coming from some tech founder or a blockchain maximalist. It's from historically one of the most vocal blockchain skeptics in all of traditional finance. When the heavyweights of the legacy banking system start radically changing their tune like this, it's a huge signal that the underlying infrastructure of finance is truly coming of age.
And that brings us to the core analytical journey for today's explainer. Is the so-called crypto winter actually over? We're going to dissect this big question today through a highly structured, data-driven lens. No guessing here. We're looking at historical parallels, macroeconomic wartime cycles, and the cold, hard math of network valuations to see exactly where this market is heading. Okay, let's dive into our roadmap for today. We'll cover 1. The crypto winter myth, 2. Wartime market bottoms, 3. AI and tokenization, 4. Ethereum valuation, and 5. BitMine strategy. Let's start right off with Section 1, the crypto winter myth. Now, to be totally fair, we have to acknowledge the reality on the ground. Ethereum has seen a really painful 65% drop since last October. It hurts, right? But let's put that into context with this timeline of historical bear markets. In 2016, we had an industrial recession. In 2018, aggressive Fed hikes. In 2022, the big inflation fight. And looking ahead to 2025, tariff wars. The key takeaway here? Every single past major crypto decline strictly coincided with a broader 20% equity bear market in traditional stocks. Basically, the crypto market didn't just crash on its own. It crashed because the entire global stock market was having a heart attack. But contrast those historical paired bear markets with what we're actually seeing today. The source data characterizes today's situation not as a full-blown crypto winter, but as an isolated mini-winter. Why is that? Well, because the broader stock market hasn't crashed 20%. Instead, the recent drops in crypto were driven by very specific events. Primarily an October crypto deleveraging event, which was basically a rapid unwinding of borrowed money, and a broader market reaction to the Iran war buildup. Right now, crypto's actually correlating heavily with AI software stocks, rather than suffering from a macro stock market crash. Moving on to Section 2, wartime market bottoms. So let's look at the macro reality. Bitcoin perfectly mirrors the S&P 500. If we want to know what crypto's doing, we absolutely have to know what equities are doing. And historically, the stock market does something totally counterintuitive. It bottoms on bad news. Let's look at World War II for a second. The US entered the war in December 1941, but the stock market actually bottomed just 5 months later in May 1942. That was before the Battle of Midway, a massive turning point in the Pacific, even began. By D-Day in June 1944, the market was already rallying. Markets digest the shock of war early, and then they immediately begin pricing in the economic stimulus that inevitably follows. And here is how that directly applies to our current macroeconomic indicators. Wartime stimulus essentially equals earnings growth. Right now, there's roughly $700 billion in proposed additional spending. On top of that, despite all the geopolitical tensions, oil has actually dropped below $100. And maybe most importantly, the VIX, which is the market's fear gauge, spiked way over 30 but has now dropped back below 20. History shows us that when these specific conditions are met, it marks a major low. We could literally be paving the way for a massive equity bull market running all the way through 2028. This is the exact kind of environment where fortunes are historically built.
Let's move to Section 3, AI and tokenization.
Okay, so if the macro bottom is truly in, what are the specific technological catalysts that are going to drive the next cycle? Well, since the recent war buildup started, Ethereum has already quietly outperformed the S&P 500 by nearly 20 percentage points. It's positioning itself for a massive move, all because of tokenization. This is the process of making almost every asset out there synthetic and digital. The source material compares this to the monumental shift back in 1971 when the US exited the gold standard. That unleashed decades of massive financial product innovation, and tokenization is doing the exact same thing today. And here's the real kicker. Even if regulatory efforts in Congress, like the Clarity Act, end up failing, software engineers are just going to keep building these future products entirely outside the traditional banking system. The tech simply will not wait for the red tape. The second major driver is Agentic AI, autonomous artificial intelligence. For Agentic AI to function at all, it fundamentally requires blockchain infrastructure. Why? Because an autonomous AI agent needs a secure, decentralized identity to operate, and it needs to execute micropayments in tiny fractions of a cent. I mean, AI bots don't have pockets to carry around a Visa card, right? They absolutely do not want to use slow, expensive legacy rails. They need the speed, the scale, and the specific unit economics that only blockchain can provide.
That brings us to Section 4, Ethereum valuation. So, the crucial point is, how does this tech necessity translate into actual value? Let's walk progressively through these exact valuation steps derived from the presentation. Step 1 assumes a projected fair value for Bitcoin at $250,000. Okay, now step 2, if Ethereum just returns to its standard 8-year average price ratio against Bitcoin, that puts ETH at $12,000. Going higher to step 3, if ETH reclaims its 2021 high ratio against Bitcoin, the price jumps up to $22,000. But step 4 is where it gets incredibly fascinating. If Ethereum achieves true payment rail parity, representing about a quarter of Bitcoin's value, it hits $62,000. $62,000. Just take a second to process that final target number. If the market follows previous historical price cycles, this represents a staggering 30x move for Ethereum over roughly the next 3 years. It's a mathematically derived projection based entirely on historical ratio parity and the massive influx of utility from AI and tokenization. For anyone paying attention to digital assets right now, this is a target you simply cannot ignore. And finally, Section 5, BitMine's strategy. So how do traditional companies actually position themselves for a potential 30x move? Well, look at BitMine. Their acquisition speed has been nothing short of breathtaking. They operate explicitly as an Ethereum treasury, using traditional capital markets to aggressively grow. According to the source, they've rapidly acquired 4% of the entire global Ethereum supply in just 10 months, and they're targeting 5% by the end of this year. To fuel all of this, they've uplisted to the New York Stock Exchange to attract institutional capital, and they launched Maven. Maven has quickly become the world's largest single-service staking operator, generating massive daily yields in ETH. But here's the thing, they aren't just buying ETH. BitMine made a $100 million strategic investment in a company called ACO, or Orbs. Look at this unique portfolio breakdown. 30% is an authorized position in OpenAI. 22% is in WorldCoin, which taps directly into human identity via Sam Altman's WorldChain, which, by the way, is absolutely crucial for a world populated by AI bots. And 8% is tied up in Cash, ETH, and Beast Industries, which is a banking initiative by Mr. Beast aimed squarely at Gen Z and Gen Alpha. They aren't just buying tokens, they're strategically investing in the infrastructure and the audience of tomorrow's internet. And this brilliantly illustrates why this corporate strategy matters so much to traditional investors. Just look at this performance comparison over the same time frame. Ethereum gained 22%, which is totally solid, but BitMine's stock, it saw a staggering 500% gain. By successfully leveraging traditional capital markets and those aggressive staking yields, BitMine has drastically outperformed the underlying crypto asset. If Ethereum actually hits that $62,000 fair value we discussed earlier, the projected upside for a structurally leveraged stock like this is absolutely massive. Well, we have definitely covered a lot of ground today. We've seen how wartime macroeconomics reliably signal market bottoms. We've explored how tokenization and agentic AI practically demand a new decentralized infrastructure. And we've seen corporate strategies actively leveraging capital markets to corner the supply of Ethereum. So I'm going to leave you with this final provocative thought. With all this data pointing to a brand new era for digital assets, is traditional finance finally ready to embrace the digital payment rails of the future? Think about it. Thanks so much for joining me for this explainer, and keep learning.